Welcome to This Explainer. Today, we're unpacking a massive financial contradiction playing out right now in the booming clean energy market. Imagine a company that does everything perfectly on paper, breaking records, beating estimates, but then just watches its stock absolutely fall off a cliff. Well, that's exactly what we're looking at.
Okay, let's start by grounding ourselves in the physical hardware. What you're seeing are solar trackers. They are the moving, mechanical backbone of modern utility-scale solar farms. Instead of just sitting there stationary, these systems physically track the sun across the sky to maximize energy capture. And the company at the center of our explainer, ARRY Technologies, is a huge global player in this exact tech. And look, the global demand for this hardware is just staggering. A recent Wood Mackenzie report showed the worldwide solar tracker market hit a massive 134 gigawatts of direct current capacity. To put that in perspective, that is enough to power millions of homes. We're talking about a market that just grew 19% in a single year. The macro environment, it's absolutely booming right now.
But that brings us to today's big financial mystery. If the macro market is booming like crazy and demand is higher than ever, why did a major manufacturer just see its stock completely fall off a cliff? ARRY Technologies announced a record $2.4 billion in orders, and Wall Street reacted by wiping out 23% of its value before the market even opened. So what happened? Let's figure this out. Part 1. The solar tracker boom.
So looking at that Wood Mackenzie data, not only did the global market grow by 19%, but U.S. domestic tracker demand specifically shot up by 25%, crossing that 40 gigawatt mark. This is a huge detail because the American market actually pays out a much higher revenue per watt than international markets. It's literally the epicenter for smart software, M&A activity, and innovation. For a company like ARRY, the table was set perfectly, directly fueling what looked like an absolute blockbuster earnings report.
Part 2. ARRY's record quarter. Seriously. On the surface, these numbers are fantastic. First quarter revenue came in at $223.4 million. They posted an adjusted gross profit of $68.7 million. That's a really healthy 24% jump from the previous quarter. Adjusted EBITDA, which is your core operational profitability, skyrocketed 157% sequentially. But the real crown jewel here is that record-breaking $2.4 billion order book. And get this, over 95% of it is locked in domestically, right in that lucrative U.S. market we just talked about.
On top of the financials, they are really innovating. Their advanced DuraTrack hardware features this patented passive wind stow technology, and customers are loving it. Actually, newly introduced tech products are driving a whopping 53% of that record $2.4 billion backlog. They've got the right products in the right market at exactly the right time.
Part 3. The 23% stock crash.
All right, so here is where the data just takes a violent turn into the red. Despite crushing top-line revenue estimates and securing literally billions in future orders, ARRY's stock nosedived 23% in pre-market trading, triggering a massive Wall Street sell-off. The company essentially yelled, "Business has never been better," and the market replied by immediately hitting the eject button.
Part 4. Unpacking the margin fears.
To get why investors panic so hard, we have to ignore the top-line revenue for a second and dig into the underlying profitability. Financial analytics firm thesis actually hit the nail on the head here. They noted, this is fundamentally a margin story, not a demand one. See, the market knows ARRY can sell solar trackers. That $2.4 billion backlog proves it. But what terrifies investors are the hidden costs of actually fulfilling those orders. Will ARRY actually make a profit on those billions in sales? That's the real question.
And the forward guidance tells you everything you need to know. ARRY is projecting full-year adjusted earnings per share between 65 and 75 cents, but Wall Street was banking on 86 cents. Huge miss. Plus, their prior Q4 adjusted EBITDA actually missed estimates by almost 30%. What this signals to investors is that sure, you have all these exciting new orders, but you're going to convert them at significantly lower profit margins. It's a structural reset that completely broke the long-term earnings thesis.
Part 5. Short-term technical warning.
Unsurprisingly, this fundamental earnings reset totally shattered the stock's short-term technicals. Stock scan data is basically flashing red everywhere. We're talking 10 different sell signals across moving averages, from the 10-day straight through to the 200-day. Now, momentum indicators like the relative strength index are sitting around 40.7, so neutral, meaning it's not technically completely oversold just yet, but the sheer downward momentum paints a really bleak picture for the immediate future. In fact, analysts point to a critical pivot level right at $8.50. If the stock breaks below that line, technical models suggest the floor falls out. The average 30-day downside target drops to a staggering $1.75. That would be a massive 75.4% collapse from current trading levels. That is the toxic short-term reality these investors are grappling with.
Part 6. The long-term horizon. But the narrative flips dramatically if you're willing to zoom out. We're looking at a crazy juxtaposition here. On one side of the scale, you have this toxic short-term margin crunch and a technical breakdown. But on the other side, a wildly bullish long-term macro environment. The whole world is transitioning to clean energy, and solar trackers are basically non-negotiable for efficiency. Because of that undeniable demand, long-term forecasts actually project the stock could hit an average target of $17.75 by 2030.
So I want to leave you with this to chew on. ARRY has the tech, they have the market, and they absolutely have the orders. But right now, costs are eating their margins alive. Does this structural reset make ARRY a classic value trap for investors who are just mesmerized by top-line revenue? Or is it a delayed gold mine for patient investors betting management will eventually widen those margins? Thanks so much for tuning into this explainer. Keep a close eye on those upcoming margin reports, and I'll catch you next time.